Well, thank you for tuning in to this online presentation, Best Practices for Growing an Insurance Agency. My name is Michael Mensch. I'm with Agency Brokerage Consultants. We do valuations and mergers and acquisitions for independent agencies around the country. And in doing that, we've noticed some attributes of successful agencies. And so I put this together wanting to share that information to a broader audience. And so you'll go through this. We'll cover a lot of different topics. Hopefully you'll glean from this some information that you can put to practice. But if you have any questions, feel free to call me or email me. My contact information will be on the last slide. So without further ado, we'll get started. Quick overview. We're going to go through a brief introduction. Then we're going to talk about managing your agency's finances, keeping and growing what you have, finding new business, acquiring someone else's agency or book of business, and then I'll leave you with some final thoughts. And in case we've never met, there's my photo. So recently I read an industry report that went through some attributes that are needed to succeed in an insurance agency. Most of these are pretty obvious. Having carrier access is one of the key ones. Having networking and marketing skills, understanding the products that you're selling, having technological capabilities, utilizing technology to improve how you run your agency and data management, being versatile in the market, and complying with state and federal regulation. In simpler terms, though, agency success is typically contingent upon 1, effective management of an agency's finances, keeping the business that you have, that's keeping the accounts that you've already written, acquiring new business, and if you really want to grow, acquiring someone else's agency. The fastest growing agencies in the country are those that are out there acquiring other books of businesses or agencies. Based on the nature of the business, the retention rates are typically pretty high, so you can usually retain most of the business you acquire and then continue to grow organically. So these are the 4 topics I'm really going to focus on for the rest of this presentation. Managing finances. Most agencies fail to grow due to a lack of capital or financial mismanagement. That's common with most businesses, but it's also common in the insurance agency business. If you want to grow, you have to continually reinvest in growth, meaning don't strip out the profits. A lot of agencies get to a certain level where the owner's comfortable with the income, and then the owner just takes out all of the excess capital and uses it for their own personal life. Some considerations: your business's financial model, proper accounting, budgeting and cash management, monitoring, productivity. So what we're going to talk about is understanding your business financial model, how to properly handle your bookkeeping and accounting, thinking about budgeting, and then just keeping your thumb on your business by monitoring your productivity. So first off, what is a financial model? Financial model really is the allocation of the money that you have coming in to cover specific expenditures. So of the revenue, how much is going towards payroll, how much is going towards rent, advertising, all those things. What is a financial benchmark? It's really a comparison of your operating performance against other competitors in the industry, how they're spending their dollars to different financial allocations. And why should you know these things? 1 is you want to maximize the profitability and the value of your agency. 2, maximize the productivity of your staff and your marketing dollars. And 3, budgeting for the future to make sure that you have enough money set aside to continue operation of the business. Some years ago, I created this breakdown, basically looking at agencies from under a financial model from 2 perspectives. One is one that has a sales-driven model where you have primarily producers out generating business. The second is from a marketing-driven model where the agency is doing most of the marketing and driving the phone calls and all the leads. And so based on your marketing model, that kind of drives your financial model. So agencies that have producers, typically 20 to 25% of the revenue is going out to pay producer commissions. Versus the ones that are marketing driven typically don't have producers, but they're spending a higher amount in the category of marketing, advertising, and promotion. And then you go down the list, there's salaries and wages generally between the two, ranging from 20 to 30% of the total revenue. benefits, taxes, insurance, anywhere from 5 to 8% and on down the list. But what you'll notice is agencies that are sales driven, meaning they have outside producers, tend to be less profitable than the ones that are marketing driven. So the marketing ones I typically would say are personal lines agencies. They're doing their own lead generation, and then they just have CSRs in-house that are taking the orders. There are niche commercial lines agencies that operate under a similar model where they've focused on a specific target niche and they just market to that, and then they have people in-house that are taking the orders. So on the bottom there, you see the net profitability under the sales-driven model on average ranging from 20 to 40% of revenue. Marketing-driven, 35 to 55% of revenue. And then usually what happens is most agencies have somewhere blended model between that. They may have a few producers, and then the agency is doing its own marketing as well. So your financial model can be somewhere in between there. And just a note, under net profitability, I'm taking out the owner's salary benefits and depreciation, amortization, all those things. So this is after deducting whatever the owner's paying themselves in the salary and all the other benefits. So if we added those back, the actual profitability on the financial statement would probably be less, but we're looking at what the owner is really taking. So this is a summary that I put together, though, based on our own analysis of agency financials and then looking at some reports from the National Alliance Research Academy. The one thing you want to do is look at your own business financials and compare it against these models to see where is it that you line up. Are some expense items in your agency running high or low, and why that might be. Optimum profitability is typically found when business is stable. The reason being that when business is growing, an agency tends to reinvest. You're hiring new people, you're buying new equipment, upgrading software. Businesses that are shrinking are struggling to manage costs. A couple of years ago, when we were in the midst of the recession, we saw profitability shrink because agencies were holding on to staff too long or had larger facilities than they needed as the revenue shrunk because of the recession we were in. So, optimum profitability is usually when you're in a stable marketplace and the business is ticking along, maybe increasing a couple % of revenue per year. An agency operating on the low end of profitability may have structural problems. Usually we see that in the compensation. Too many people paying their staff more than the market rate. Agencies on the high end of profitability, the business may be run very efficiently or could be a sign that it's not reinvesting in growth. So what I'm talking about is agencies that, their profitability is half of what it was on that previous financial slide. Usually when we see that, there's too many staff. When the agencies on the extreme high end of the profitability slide of the last slide, usually what we see is that maybe they're understaffed, or a lot of cases the owner is the key producer in the agency and they're writing a lot of larger accounts. So those are just some reasons why you may have some discrepancy on the average profitability. Briefly talking about CSRs, their compensation is usually salary or hourly based. They may have some incentive bonuses for writing new business, doing the paperwork properly. You can give them $5, $10, $15 for doing certain things. Benefits, they usually have sick and vacation time, sometimes health insurance benefits. Total compensation for CSRs is usually less than 35% of revenue, or that's really where you want it to be. I've seen agencies where their total compensation to CSRs is 20%, sometimes even less than that of the total revenue. So if you're more than 35% of revenue going to your staff, then you may want to look at how things are being handled internally. A little bit about producers. Their compensation can vary by the market and their responsibilities, meaning it can vary based on the geography. Different areas of the country are a little more competitive to get good producers, so you may have to pay them more. Also based on what they have to do. If they're doing their own processing and quoting and putting together proposals and everything, they get paid more than if they're out there just generating new sales and making the pitch. May include a draw for newer producers. A lot of times you have to invest in getting a new producer started. It may take a year and a half to start getting a real return on your investment in a producer. So which is why it's really important to make sure you screen them. But generally the producer should be getting paid somewhere around 40% for the new business and 30% for renewals. When you start to deviate from this model, paying 50%, it starts to really have a detrimental effect on the overall profitability of the business. And I always say avoid giving ownership rights to the book of business that the producers generate. That just creates a problem. I mean, it's your business. You've got the relationships with the carriers. Typically, your staff is helping the producer. So you really don't want to give up ownership. There's other things you can have, different types of compensation or deferred compensation to reward them for growing their book of business, but try to keep ownership at all if you can possibly. Talking about accounting, most bookkeepers and accountants have a difficult time with agency financials. Usually they create financials from bank statements. So what we see usually is the accountant may monthly or on an annual basis prepare financials for the agency owner. A lot of times they will look at the bank statements to do that. They don't reconcile with the management system or carrier statements. So they're basing it on the bank statements, and that can create a problem for a number of reasons. Primarily, if you're transferring in money from your own account, then they may capture that into the agency's revenue. We've seen that before, where the owner transferred in maybe $20,000 or $30,000 of their own money into the accountant. The accountant actually captured that as revenue, and the owner had paid income tax on that additional revenue. So you want to make sure that they're checking the bank statements against the carrier statements, against the management system, and just kind of looking that everything lines up. Recommendations we usually give is track monthly revenues by carrier statement. So create a spreadsheet by month, by carrier, of the actual money that you received based on the carrier statements. Track agency bill deposits and commissions. We see a lot of agencies that do agency bill business, and they have no idea how much commission dollars they're actually earning. They take the money, they put it in the escrow account, and then at some point they'll take some of the money out, but they're really not tracking how much agency bill revenue they should be getting. And then compare against your company financials. So take those spreadsheets of your commissions by carrier based on the carrier statements and your register of all the agency bill deposits, and compare it against what's going into the bank account to just reconcile between the three of them. Just want to mention about when to hire a CFO. We've seen agencies that have $1 million in revenue with CFOs, and we've seen ones with $8 million in revenue that did not have CFO. But just as a general rule of thumb, if you're $2 million of revenue, you're probably too early to need a full-time chief financial officer. If you're $7 million of revenue, you probably need one at that point. So somewhere in between that range is usually where you need to start looking at when is the time to hire a chief financial officer. But if you're on the low end of that, most of the time those people are getting paid $80,000 to $120,000 a year. So it's really not necessary until you hit a certain size. All right, talking a little bit about budgeting. Because your business is one that has such stable recurring revenues for the most part, makes it a little bit easier to budget year over year what your financial is going to look like. So what we recommend is taking a look at your monthly revenue and expenses from the prior year and budgeting that out in a 12-month period, just so you understand what your cash flow is going to look like month to month going forward. And it kind of gives you an idea. Just, some agencies, the revenues are relatively stable, but most of them have fluctuations throughout the year. Some have significant fluctuations. We looked at one that a third of their revenue came in about a 45-day period of the year. And so they understood that they had to budget and set aside money to cover the months where they really went in the red. But this is just a general good practice for running a business. When dealing with cash management, we always recommend keeping at least 3 months of working capital in the business. That means, being able to cover the operating expenses for 3 months. This helps you survive unforeseen events, including seasonality or market cycles. In Florida, we have this issue of carriers every once in a while going out of business, and then the agents are rewriting that business. They may have chargebacks. So sometimes you just don't know what's going to happen. I mean, you could hit a disaster in your area, and that could really put a hurting on your business for a period of time. So you just want to make sure you're prepared for the worst. And then when you're saving that money, it allows you to invest in growth or acquisitions. Now you're managing your money a little bit more conservatively, and so you have some more available to reinvest and continue to grow. It should come without saying, but don't spend what's not yours. Always remain in trust with carriers. We've seen agencies that were significantly out of trust, to the tune of $1 million or more. One agency we looked at was 100% of their annual revenues out of trust. Somehow or another, somebody had spent a significant amount of their trust money over a period of time, and probably about 6 weeks when we met with that owner, the FBI came in and arrested them. So it does happen. It seems like it shouldn't be needed to be stated, but it does happen where agencies get out of trust and get themselves in trouble. And I always recommend, too, make sure that if you're getting paid in full on commissions, that you set aside additional monies in case, again, the carrier were to go out of business or you have a massive cancellation of policies or something, because you don't want to be stuck with tens of thousands of dollars in chargebacks. So I would say failure to follow these rules can lead to a fast decline. As I said, when you're out of trust, you can get arrested, thrown in jail. You can find yourself in a lot of hot water. So just be careful when you're managing your money that's coming in. Always be conservative and set aside enough to cover the worst case scenario. Just giving you some financial metrics. One thing to look at is days of working capital, meaning how many days of your operating expenses you can cover based on the cash that's in your bank account. Looking at your trust ratio, that's saying how much cash you have plus the accounts receivable divided by the accounts payable. Should always be greater than 1. You want to have more liquidity than you're owing out in accounts payable. Looking at the tangible net worth of your business, that just gives you a metric of how well you're getting a return on your assets. And then the rule of 20 has to do with just taking a look at how well you're growing your business and combining that with the profitability of the business. So it gives you a metric of you should be around a score of 20 when you take your organic growth rate, add to it your EBITDA margin divided by 2. So if your agency is operating at a 30% EBITDA margin and you had a 10% organic growth, well, that would mean 10 plus 30 over 2 is 15. So 20, your rule of 20 would actually be 25 score, and that'd be pretty good. So these just give you some financial metrics to track and keep an eye on to make sure that you're operating your business properly. Monitoring productivity. First, you want to be tracking where you're spending your marketing dollars. So look at the cost per lead, the closed sales per lead source. We're going to talk about this more later, but you should always be tracking how effectively you're using your marketing dollars. Of CSRs and producers, look at the revenue per person and the margin per person. So what's your overall commissions divided by the number of CSRs, how much you're paying the CSRs, how many accounts are they managing, just keeping an eye on. And there's some averages that I'm giving in the table there, but comparing yourself against these averages. So if you have $500,000 in revenue and 4 employees, that means you're averaging $120,000 in revenue per employee, and that puts you kind of on the low end of the scale. Usually it's easier to be in this range. The larger agencies tend to be a little more efficient. So once you get to a couple million in revenue, that scale should increase. Looking at accounts and lines of business, tracking your premium, revenue, policies, your average high and low tenure of accounts. Why are some sticking on the books longer than others? Is there a certain product line that has a higher retention than others? Is that an area you should focus on? And then what is the number of policies per customer, or your staff doing a good job of cross-selling? So these just give you a number of different metrics to be looking at to make sure that things are running at the optimum efficiency in the agency, and that keeping your thumb on the business, basically. Finances, let's talk about keeping and growing what you have. First, I put together a little model just to kind of quickly demonstrate the difference that retention has on your book of business over time. So these all three are based on a simple growth model. The only difference is the retention rate. So red line represents an 80% retention, blue 88, green 96. And what you see is over time, over a period of 10 years, the difference between 80% and 96% is 66% more policies on the books for the agency with a 96% retention over that with the 80%. And basically that represents 1 or maybe even 2 years worth of work. So the whole point is just to put in your eyes a visual presentation of how the retention affects your business over a long period of time so you can understand this and kind of let it sink in. So that way you focus on things that may improve the retention in your business. So questions to ask yourself: how much does it cost to acquire a customer? How much revenue is lost when you lose a customer? And which agency of that previous graph is most likely more profitable? I just threw out some guesses here. Probably cost you at least $100 to get a new account. Probably losing at least $400. You know, we're just taking even on a small personal lines account. Probably when you lose an account, you're probably losing at least $400. I'm taking, over so many years, how much that small account would have produced in revenue. And which agency is likely more profitable? The one with a 96% retention is netting 10% more of revenue than agency with 80% retention. And I'm saying this based on just because there's less servicing work and less. So I did some research, but thinking about the question, where do customers go when they leave your agency? So they basically have three options really. They can go to a direct writer, or they can go to other agents, which would include independent and captive agents. Let's talk about the direct writers. There's a study that I referenced at the back of this presentation that says consumers that use an agent claim they do so because they like dealing with a person they can visit, 39%, or have always used an agent, 31%. So it's saying that a consumer that was with an agent, the majority of the time, they would rather be with an agent. So if somebody once used an agent, they're more inclined to want to use an agent because they feel comfortable with it. It's something they've done. So the message of that is if they leave you and go to a direct writer, they don't want to really be using a direct writer. They just either found the price cheaper or the convenience better. So the whole idea is most agents we talk to, somebody leaves and goes to a Geico or something like that after 9 months or whatever, the customer's usually not satisfied because the price goes up or the service is terrible. So the whole idea is stay in front of that customer even after they leave you. Continue to reach out to them every 6 months, 3 months, whatever you want to do, because they will likely have buyer's remorse and start shopping again. If an agent or a customer leaves an agent and goes to another agent, they're doing it because either the current agent lacks the markets that the new agent has, so the new agent is quoting a better price or better package, or they're doing it because they're not satisfied with the service. Well, I tend to believe that, unless it's a drastic difference in price and coverage, if you're doing an excellent job with service, they're going to be more inclined to stay with you. So I think a lot of times it boils down to is the service, because a lot of agencies, even if they don't have direct contracts, they can broker business and place it where they need to. So typically, I think if you're losing them to other agents, it's because the customer's not satisfied with your service. And so that's what we're going to talk about next, is service. So I did this little graph breaking down the elements of service. You got communication, convenience, likability, responsiveness, professionalism, accountability. There's probably other elements, but I'm just trying to narrow down on some of the key elements of service. So the first element of service to talk about is communication. This deals with how frequently you are reaching out to your clients, and the best way to do that is to share information with them that is helpful and helps educate them about things they need to know. So you can do that by regular emails, you can do that by Facebook or social media. But just sharing with them different things about coverages and claims, how they handle claims, getting prepared for disasters, any changes going on in the marketplace with different carriers and such things like flood insurance, what's going on right now. You can share information about the agency, what's going on within your agency, and any major events for staff or awards or recognitions for your staff. And then, of course, share with them how they can reduce their insurance rates, because that's probably the most valuable thing to them. A study said that consumers are 10% less likely to shop if they hear from their agent regularly, and increased communication improves retention by 5%. And you can see those references at the end where that information comes from, but there's a financial benefit to communicating, and generally it doesn't cost much to send emails or keep updating things on Facebook, so it's not an expensive means of providing more service to your clients. Always let your clients know that you appreciate their business, so reach out to them on holidays and things and birthdays maybe. And I talked to an agent recently that once a year will send birthday cards to his clients, and if he ever misses one, they send him a letter, jokingly, because he's done it for so many years. So not too many agents do those kinds of things. Next one is convenience. It should be part of your value proposition. Most people buy from direct writers because it's more convenient. They offer 24/7 customer service. You can buy online. You can call the service centers. Some statistics: 83% of agencies do not have an online portal. 42% have no self-service tools like being able to pay bills or make policy changes online. 62% do not offer online quoting. And again, when you've got companies like Progressive and a number of other ones that have online quoting, if you're not offering that service, you might be missing out on opportunities to reach new customers. But the whole key is to make it easy for them to do business with you. If you're only open 7-8 hours a day, it kind of makes it difficult for the customers to get in. Some of them might be working. It makes it difficult for them to reach you during working hours. So sales is all about likability. So you want to make sure that the staff that you have are connecting with your customers. So do they have the right attitude and enthusiasm? One agent that I talked to before said that's one of the key attributes he looks for when he hires people is, he said, I can train people to do anything, but if they don't have the right attitude, that's not something that I can train them. And so always make sure your staff has a good attitude. Are they empathizing with the customers' problems and issues that they're having? Do the staff have personality that they're able to connect with the customers on? And some of these things you can train them just to how to handle different calls and how to answer the phone. Processes should be written and followed consistently. Communication should be professional. I'm always amazed at how many businesses nowadays don't have internet domains on their email, so they might be using Yahoo or Bell South accounts, and they don't have email signatures, so that there's no phone number at the bottom of their email. So make sure that all communication coming out of your office is professional, and emails, it's not expensive to set up a website and have emails through that website, and it doesn't cost anything to add email signatures. Make sure clients have account managers so they know who they need to reach out to if there's a problem. And make sure that your agency is creating a great customer experience. So when they're connecting with your office or contacting your office, not only is they getting a good attitude from the customer service rep, but they understand that it's a professionally run business and everything is handled consistently well, professionally, with the right approach and handled diligently. So the key is just developing a great customer experience so that way people like doing business with your business. Solicit feedback. Not a whole lot of agencies solicit feedback from customers. So you can send out a survey after maybe you get a new customer. Usually you're not going to get a significant response rate from those kind of surveys, but the information you do get could be invaluable. So ask them, how well were their needs met? Was their coverage explained? Do they feel that the price they paid is good quality for the coverage that they received? What was their overall experience? What's the likelihood they would refer somebody to you? In that survey, find out who worked with them in your office, if they have other insurance needs, and see if you can get a name of somebody that they may refer to you. When you get the feedback, understand what you're looking at. So if you're sending out questions with a scale of 1 to 10, usually they say 80% or better is really meaning that you're getting a good score. The reason being, most people tend to skew to a higher scale than they really might rate something because they don't want to be offensive. But if they feel it was really mediocre, they may give you a 7 versus a 4 or 5. So really, the key is getting an 80% or better response from your customers. And any areas that you're getting low responses is an area that needs to be tackled with your staff to understand what's going on. So you maybe need to retrain people. So if one of your staff members is getting higher scores than the others, maybe need to look at what they're doing, have them do some of the training for the other staff. And if somebody is consistently getting low scores, then you may need to just eliminate them completely. Another statistic, customers are 50% more likely to shop their policy if they deem that your service is just satisfactory. So it's not above satisfactory, but just satisfactory. So let's talk about cross-selling. A number of studies have been done by carriers and consulting groups that looked at how well cross-selling impacts retention rates, and they found basically that retention rates increase 5 to 10% when you hold more than one line of business for a customer. I've got the references there. You can go look at that. I think most people it's pretty much common knowledge. By cross-selling, it's the cheapest means to grow your revenue. Another study found that 25% of consumers don't even think about giving an agent more than one line of business. So keep that in mind as you're talking to customers. They may not even think about offering it. So once you put it out there, it could be something that opens up a new conversation that they wouldn't have done on their own. So you want to train your staff to ask about other insurance needs in the initial sale. After you send out a survey, if somebody rates you pretty high on the score, then you've actually earned the right to ask for it because they're satisfied with your agency. Another idea is promote testimonials of clients that have given your agency multiple lines of insurance business. So you can put that on your website. You can put it in your email signatures. It plants the seed in their mind and makes it an easier segue for when you're contacting them and asking them about if you can be willing to quote them on other business. Then you've already planted the seed. Let's talk about building your team. The quality of your service is contingent on the quality of the people that you hire. So you want to make sure you're hiring people that have the right attitude, because again, it's not something that you can train. If somebody doesn't have a good attitude, then no matter what they learn, they're never going to have the right attitude. Make sure you hire people of good character, that they're honest, have integrity. Look for people that like to learn and are willing to listen. You want them to do things the way that you want your business runs, and if they're stuck in their ways of doing it how they learned it before, then it's going to be hard to train them that way. Look for people that need to work. Most employers like employees that have families and they need to support their family. Invest time developing people, discuss goals, expectations, responsibilities, set up training and mentoring processes to take senior people, put them with junior people. Multiply your influence, seek the top 20% of your employees and have them become leaders in your organization. And always remember that when you invest in people, your relationship goes from one of respect to admiration and then to loyalty. As you invest more time in them, they see that you care about them, and that develops loyalty from your staff. Cultivate a friendly, competitive environment. Use production-based compensation. So even if they're on a service team, you always should have some kind of financial reward for doing things the right way. Have regular meetings, share successes with the group. So if Betty and the personal lines department saved a prospective customer $1,000 on their homeowners in this specific neighborhood, let her share that with the group so they know that when they're talking to people in the neighborhood, that they can use that as a sales pitch. Have social gatherings, give awards. The whole idea is create rapport within the office and create camaraderie, so allow them to have fun too in the office. Incentivize growth, set goals on individuals and on teams. So you want individuals to be accountable, and then you want them to work together as a team as well. Add incentives for higher production, add incentives for longevity. So you always put a financial reward behind things that you want people to do. Create accountability. Have people accountable for the things that they're doing. And if that doesn't work, outsource. There are plenty of places you can outsource nowadays. Carrier service centers. A lot of bigger carriers like Travelers and Nationwide will handle servicing for the agency. They typically charge 10% of the commission. It's a 24/7 service. So again, now you've got convenience. It's a company called Wave, which has semi-retired insurance agents for hire. They work from home. They can do processing of policy information, and they're experienced. They work, on a as-needed basis. It's a company called Resource Pro out of China that does a lot of processing and support staff. They're also 24/7 available. Their staff are trained in insurance. And so this will give you some outsourcing resources that if you ever have an issue where you need more staffing instead of hiring them, sometimes you can just outsource the overflow of work to any of these different groups. So we talked about agency finances. We talked about keeping the business that you have. Now let's talk about one of my favorite areas, which is finding new business or marketing. So every marketing should start with a game plan. You assess the market for opportunities. So you look at what's out there, how many consumers in that market, look at who the competition is, what carriers are writing in that market that you're looking at, identify your target customer, develop your value proposition, how you're going to stand out from the competitors in that space, and then you go forward and promote your business through a whole bunch of different marketing avenues that we're going to get into. Some numbers to think about. The average agency spends 3 to 5% of revenue on marketing and advertising. Roughly 65% of agencies report having no formal marketing plan. That's pretty significant. Over half of agencies do not track where their leads are coming from or their ROI. So they're spending all these dollars on advertising and marketing, and they're not tracking, what is actually producing results for them in their agency. So you can really break marketing down into two classifications. One is called push marketing or interruption-based marketing. That's where you're putting your brand in front of somebody wherever they're at. So that can be direct mail, it can be TV, radio ads, it can be email blasts, it could be cold calling, telemarketing, all these different things where you're getting yourself in front of somebody and interrupting whatever they're doing to get the conversation or get their attention and to see your brand and your value proposition. The next class is called pull marketing. Oftentimes this is reputation-based marketing. So you're not just sticking an ad in front of somebody, but it's based upon your reputation that they're calling. So a lot of times most agencies get referrals from customers, from other advisors, other professionals. And so that's based upon your reputation. The people are saying that you do quality work. That's why you're getting the call. You can have affiliate relationships. Maybe there's a professional association that you market your health insurance through, and so you capture all the dentists or the doctors in that group. It could be based on videos you have online. Somebody goes and searches out, they're looking for specific insurance coverage. They find your videos or your blog or your social media online. They do a lot of research. They're watching all these things, reading it, and from that they glean that you're a person of knowledge and integrity. It can come from networking, publications, speaking engagements, all these things. But so just understand that there's two ways to think about marketing. One is the push model, one is the pull model, and whichever one works for you is going to be the one that you should put your efforts behind. So which of those methods work? Well, you pick a method, and we can tell you about an agency that found success with it. We knew agencies that grew through radio and print ads. Back in the day, yellow page ads were big. Known agencies that grew through SEO and purchasing leads. We've known agencies actually that grew significantly through those areas. Agencies that do trade shows and conferences and speaking engagements, do all sorts of things. Any one of those methods you can be successful at, but the key is really understanding who your target customer is, and then the question is, how do you get in front of that person and get your value proposition to them? So depending on who that is, that's how you pick which method or methods will work best for you. If you're a business owner, you should be a student of marketing. So study the trends, understand the different avenues you have to promote your business. Pay attention to new methods that are out there so you can follow certain people that are leading the industry. I like to follow Chris Paradiso of Paradiso Insurance up in Connecticut. A lot of people know who he is, but Chris really jumped into the social media marketing years ago, and it's been reaping the benefit for him now. He kind of stays ahead of the curve on different things that are going with online marketing and digital marketing. One of the new things that Chris is doing, which I thought was interesting, is there's a thing called geotexting. So if somebody drives by your agency, you can have a text message sent to them to get their attention. So just know the different things that are out there. There's a lot of things with digital marketing right now that are changing on a monthly basis. And so you want to become a student of that and stay ahead of the curve, understand what's happening. Because all the people that jumped into blogging and all those things a couple of years ago, they're reaping the benefit of it now, because all that is weighing heavier into search engine optimization and all that. So usually if you're staying on the front end of marketing trends, you'll kind of reap the benefit a year or two down the road after those trends start, and you'll be ahead of the rest of the pack. Some stats on agency website functionality. Again, you can, at the end of this, see where I got these references. But 12% of agencies still have no website. That's pretty astounding. 54% of agency websites are not mobile friendly. That's going to become a bigger factor over time as more and more people are searching on their mobile phones for different things. So if you're not mobile ready, you need to get your website mobile ready. Over 65% of agencies do not have customer testimonials on their website. That's also astounding because, that's what people are looking for. If I'm a consumer and I'm shopping online, I want to see those kind of things on an agency or whatever customer or whatever supplier's website. You want to hear what other people have to say about them. 38% of personal lines agencies, 49% of commercial lines agencies are not using social media. 67% of agencies do not have a blog. That's a mistake with organic rankings, the way they work. Blogs are what they call Google food. There's that the Google looks and weights that heavily. Over 50% of agencies do not have in-depth content on their website, and 39% of agencies are not using local search tools. So those are all statistics on agency marketing online. If you are an agency owner, this should be also maybe shocking, but also encouraging, because it means there's a lot of opportunity through online marketing, because so many people are not taking advantage of what's out there and what's available. Let's talk now about specialization. Someone once said there are riches in the niches, and it's very true. Only 14% of agencies have a website targeting an industry or product segment. That's also very shocking, because when you look at the space for online marketing, when you Google search certain keywords, if you do homeowners insurance or car insurance or all those general lines of insurance, it's very competitive. But if you go into searching pet insurance or who knows, classic car insurance or anything that's more targeted, this competitive space is a lot more thinned out. So one thing you should consider is developing an area of specialization and then putting together a website targeting that specialty. The number of specialized agencies rose by 10% from 2010 to 2013. So when the economy got tough, people started specializing because they realized that was an area that they could grow, and they did. Benefits of specializing: faster organic growth, higher retention and profitability, better competitive edge. I have a little bit more of this on our blog about specialization, but it's a great thing for you to consider if you have an area that you're passionate about, whatever that may be. Could be, rec sports or animals or whatever it is. A lot of times you can specialize in that. You could develop a website around that. And the great thing is nowadays people, especially when they're looking for people that share a passion about a certain thing, they don't mind shopping and buying online, even if you're a couple states away. So it's a lot easier nowadays to specialize and promote your business online. Strategy for specializing: assess the market opportunities, test the waters, see if there's really, before you go and spend money into putting something together, test it out, see if there's a demand, see if you can place the business. Assign a practice leader, somebody in your office that is going to head up that area. Build your marketing plan, set up a DBA and a website, create marketing materials, align with referral partners. So if you are, targeting classic cars insurance, then go and align with organizations that do those gatherings for classic cars. Promote your specialization and then become an expert. The definition of expert is mean you know one more thing than the rest of the people out there. So becoming an expert, after you've done it 5-10 times, you start to get to know more and more information. As you become more of an expert, the carriers will open up to you writing more business with them, and they start to lean on you because you understand the questions to ask in that risk area. And so over time you learn more and more about it, and that allows you to open up new opportunities, not with just carriers, but with different referral partners and everything. So that's just a basic outline of how you can specialize. You only find success in specialization if it's an area of passion, so make sure it's something that you have an interest in. Let's talk about tracking key metrics. Within your business, you should be tracking new leads and policies written, close ratio by staff, total new premium, revenue, policies, etc. So you're just tracking all the things, about new business production. Of your marketing, track where the source of leads came from. So if you're doing 5 different things, you're doing direct mail, you're doing telemarketing, you're doing all these things, keep a thumb on where your leads are coming from. Look at the close ratio based on the sources. Email campaign stats. The great thing about online marketing and email marketing is that you can see so much statistics on what you're doing. You can see where people are clicking. You can see what they're reading. And so there's great depth of information available when you're doing online and email marketing. Track your social media followers. That's longer term investment, but you want to know where you're getting your biggest bang for your buck as far as where you're spending your money and which areas are giving you the highest close ratios, and then that gives you an indication where you should focus your efforts. Some gurus that I follow: Scott Addis, Beyond Insurance, does sales training. Scott built the Addis Group to over $10 million in revenue in about, I think, maybe 15 years. Now he does Beyond Insurance. He goes around, trains agents around the country. He's a great guy, very intelligent, very professional. Steve Anderson, the Anderson Report, is specialized in agency technology. Dave Chaffee, Smart Insights, Internet Marketing. Brent Kelly does a great job with his blog on sales, producer sales. Dave Kirpin, Likeable Local, about branding. And again, Chris Paradiso He's really become an expert in digital marketing for agencies. So I just recommend you study what others are doing and what have made them successful and build upon that. You don't have to reinvent the wheel. The idea is go read up and follow what other people are doing and try to duplicate that as best you can. Okay, let's shift now and talk about buying someone else's agency. It's the fastest way to grow. If you look at the largest agencies in the country, they've all grown through acquisition. Brown & Brown's, the Gallagher's, all those companies are out there buying other agencies. Benefits, you get a good return on your invested capital. Often, if you're a smaller agency, you go borrow money from a bank or a lender. So you have to come up with maybe up to 20% of the down payment, and you can finance the rest. It gives you growth in revenue and cash flow. So you get more revenue, more volume through your carriers, more cash flow, not only from the agency you're buying, but also you get to pick up some synergies as you grow. Enhanced value of your agency. Agencies are valued typically on kind of a sliding scale, usually on earnings. So the bigger you are, the higher multiple that your agency is valued at. So if you got $1 million in revenue, you may be worth 5.5, 6 times EBITDA. But if you have $1 billion in revenue, you're probably worth 10, 11 times EBITDA. So it kind of gives you a range of the scale. Pick up potential synergies, get new appointments, higher carrier compensation as you put more volume with them, opportunities for cross-selling, expense reductions, new staff, broader brand exposure, all those things. I'm sure most people understand the value of acquiring agencies and books of business. Some challenges: it's hard to find real opportunities, competing with other buyers, bridging the trust gap when you start talking to an owner. You've got a long ways to go to build their trust that you can actually get a deal done. Structuring the deal, performing a thorough due diligence, closing the deal. So I've done other slides, presentations on how to buy an agency, but just highlighting some of the challenges that you have. It can take months to get a deal moving. You have to be patient. You want to keep communicating with the owner, understand the seller's motives and issues, so you structure the deal in a way that addresses any concerns they have. Quick overview of how the numbers can play out. This is really basic. In no way am I saying this is 100% accurate of how it would play out, but just throwing it out on a very simplistic level. So your agency, $1 million in revenue, acquiring one, $500,000. Combined on paper, it's $1.5 million. You're going to get some synergies from it, so you'll be able to reduce some of the expenses. It's going to grow your EBITDA. And if you finance it, looking at the bottom, you can look at these terms later, but basically just saying financing 7% interest 5 years, putting down 20%. Your before tax return on capital, meaning the amount you put down, is about 32% when you finance it, based on these terms and the price and everything. So really just wanted to throw it out there, give a simplistic view of how it looks. But even from a financial point of view, before you take in other real synergies, it's not a bad return for the money that you're putting down. Make sure you fully understand the risk factors of the agency or book of business. So what the revenue trends or changes. You're looking at a couple of years, but then also what's happening currently in the agency. Where's the revenue concentration with carriers, with clients, producers. Review the non-compete agreements. Understand the cash flow for the deal. Make a monthly cash flow projection. Understand how earnouts and bank financing work. So if you're borrowing money from a bank, it's often difficult to structure an earnout in there as well, because you're going to be paying bank on a monthly basis over 5 or 10 years. And then if you throw in on top of that an earnout payment on year 1, year 2, or year 3, something like that, it's going to probably put your cash flow negative. So just know that, and either you're going to have the additional cash or restructure the deal. Understand the taxes. You can't write off principal payments. You can write off the interest, but not the principal payments. If you plan on reselling the agency within 5 years, ask an accountant about amortization recapture, because you could find yourself paying more taxes than you expected. So I'm just running through an overview real quickly. Again, I've got a whole nother presentation on basic cash flow projection. What you want to do is lay out. If agencies have fairly consistent revenue, so you can look at historic and then project forward what the revenues are, monthly expenses. So just understand where your heavy and weak months of cash flow are going to be, adding in there your loan payments so you know what it really looks like. Okay, so ran through a lot of different things, but basically substantial growth requires a four-pronged focus. Number one is managing your agency's financials, keeping enough cash in the bank to survive any ups and downs, budgeting, maximizing the profitability of your agency, reinvesting in growth. Number two, keeping and growing what you have, focusing on retention, focusing on the people that you have in-house and the quality of service they're providing. Three, adding new clients, how you're marketing for new business. How are you going to promote your business, the push-pull models? How are you going to specialize in a certain area? And four, acquiring other agencies. If you really want to grow fast, you got to acquire books of business and other agencies, and you have to have a plan for doing that. So one thing to consider in your area, at least one agency has likely grown by leaps and bounds, so you can be the next success story. This is true all over the country. Agencies are growing even in a down market. Some agencies are growing 10, 20% a year. Others are growing even more if they are acquiring other agencies. Assured Partners went from zero to like $200 million in revenue in 3 years through acquisitions. Obviously, they had a lot of money to do that, but the opportunities are out there. You just have to plan for it. You just have to manage your business right and have a strategy for how you're going to achieve your goals. Some last thoughts, the traits of successful agency owners that we've worked with. Number one, they have a high risk tolerance. They take risks. They take calculated risks. They don't find reasons not to do things. They're thoughtful in how they do things, but they move forward and take risks. Number two, they have financial discipline. They live below their means, and they keep money in their business. They reinvest money in their business. Three, they're people-oriented. Most of them are salesmen as well. They've started insurance selling, and now they're building their enterprise. But they're people-oriented. Number four, they delegate well. That's the only way you're going to be able to grow is if you are able to delegate responsibility to other people and trust that they can get it done. Number five, they're students of their own business. They read a lot. Again, they're reading marketing. They're going to conferences and learning about their business. Six, they have a pulse on their business. They're tracking all the key performance indicators. They know what's going on a daily basis. And seven, they're action-based. Again, they're taking action. They're doing things. They're not waiting and finding reasons not to move forward with things. The other thing is many high-growth agencies have multiple principals with compatible skill sets. It's not likely that one individual will have all these skills or traits, but what we often find is there may be more than one partner in the business, and combined together they have all these things. So one may be the salesperson, the other way may be the analytical person, one may be a marketer, one may be an accountant or something. So, but just understand these are the traits that you should look for, or you should be gearing yourself towards. And if you have any gaps, maybe you should look towards finding a business partner that can fill in some of your traits, the gaps that you have. So thank you. I hope you found this information very useful. Here's my contact information. I've put this together because we consult with agencies around the country, and we find very interesting facets. Probably 10 or 20% of agency owners are really growing their business, creating value in their business. And so I just wanted to share in a broader audience the things that we're seeing so that other people can pick up on some of those ideas and run with them. So I hope you enjoyed this information. Please feel free to call me or email me. Thank you very much. And if anyone is looking for the references for the different statistics that I quoted, here they are. I did my own research trying to find data in different areas, and these are the different articles that I came up with.